everybody. Welcome back to another session. This is session number 6, and we are picking up where we left off last week about retail borrowing. So last week we covered off retail banking, and we looked at commercial banking and that umbrella term used in the US, and we discussed some of the methods of borrowing that are facilitated or offered as products and services by retail banks. So we looked last week at overdrafts, mortgages, and personal loans. And this week we'll be looking at 3 different methods of borrowing. So I'm joined once again. Very thankful to have 3 guests with me again. We have Arnie. Hi Arnie. We have Tutu, and we also have Monica. So a massive hello to all 3 of you again, and thank you very much for joining us. Hopefully the session last week didn't put you off, which is nice to see. So we're really honoured to have our 3 guests with us to offer some more insight into some of these different methods of borrowing, and so we'll come to them as we go through some of the content. So as I said, last week we spoke about 3 types of retail borrowing. So this is for individuals, so personal financial products and services. And this week we're going to be talking a bit more depth about, in order, of payday loans, credit cards, and pawnbroker loans. So they're the 3 different types of methods of borrowing that we will cover this week. We mentioned last week about the difference between secured and unsecured borrowing when we were talking about the 3 methods of borrowing, especially in terms of mortgages, overdrafts, and personal loans. But we will just recap on that. And again, it's related to the 3 methods of borrowing that we will talk about in this session. And then finally, based on those kind of 6 methods we've looked at, we'll kind of just have a quick recap and summary about different types of borrowing and why, which ones are likely to be more expensive or charge you more interest to borrow, and maybe there may be 1 or 2 exceptions to the rule. So we'll think about the kind of risk and reward relationship that we've spoken about in previous sessions, and that can be related to some of the different methods of borrowing that we will look at and today, and what we looked at last week. So there was a task that was set for you in the previous session, ready to attend this one and to apply it, and that's a bit of research around payday lenders. So payday loans is another method of borrowing that's offered to retail customers, so the general public, which is what we spoke about last week. So what I asked you to do was just do a bit of research about how payday loans work, who ideally would borrow this way, or who they're kind of meant for, who they're kind of aimed at, what the advantages and disadvantages are, and also some of the changes that were made to UK regulations or laws in order to, shall we say, mitigate some of the risks for borrowers from payday lenders. And there were a number of horror stories that originally came out about payday lending when this was quite popular a number of years back. So we'll look at that in a bit more depth there. Okay, so in terms of payday loans and how they work, really, a payday loan does exactly what it says on the tin, so to speak. The idea is that you're lent money for a short period, a very short period of time, maybe a week or 2 weeks, before the point at which you get paid. So this is very much a form of borrowing that's used for emergencies, or that's the premise of it. So the whole point is that if you don't have the money to pay for something before you get paid, you then borrow for a very short period of time and pay it back once you are paid. So it's not a form of borrowing like a personal loan where you will borrow that amount of money over a period of time and pay it back over a period of time. The whole point of these loans is very short term for emergencies, and they're paid back quickly, ideally when you are next paid your salary, which for a lot of people that's monthly. Okay, so in terms of who they are ideally meant for, now payday loans became very kind of popular after the financial crisis, where it was difficult for people to borrow money through traditional methods. So payday lenders really aim at individuals that maybe can't borrow through traditional methods. Maybe credit ratings aren't as great as they could be, or things have happened and the credit ratings might not be as high or high enough for traditional financial institutions to lend through personal loans and things like that. So these are meant for people that maybe are potentially on lower incomes, or for those that find it more difficult to borrow through traditional means. And I have to say, for the three of our guests, I remember when these were originally kind of became quite popular, and we saw a lot of advertising about payday loans on the television. How did you, just ask your opinions, can you remember some of the adverts that we saw on TV for payday loans?
I certainly can. I remember, for example, Wonga was very popular at the time. That was all over the TV. I don't see it anymore. And there were a couple of others. Quick Quid, I think, is still advertising. So I definitely remember them being marketed. And I remember some of the horror stories that came out with, 2,000-3,000% interest. There were very, very high interest. So I think a lot of people, once they took a payday loan, found it very, very hard to extricate themselves from the situation because it just spiraled.
Yeah, absolutely. You're absolutely right there, and we'll talk about some of that in a bit more detail in a moment. And I mean, if you look at some of the logos we've got up there, Peachy, Sunny, Lolly, they're all quite upbeat, happy kind of names of organisations from a marketing perspective. In terms of their names, it gives off this very kind of happy-go-lucky, Peachy, Sunny. It's quite light and airy and breezy. And actually, these things were anything but when they were first around. They were people, as you say, Tutu, got themselves into quite a lot of trouble borrowing this way. And in fact, actually, on a classroom, I put a video up there, which was a BBC documentary that you can find on YouTube. And it was about young people that had got themselves into some quite serious debt problems through borrowing through payday loans. But this was marketed very cleverly by some of these organisations. And Tutu spoke about Wonga, and the adverts that were in the forefront of my mind, they used to use these sort of animations of these sort of elderly people. I can't remember the name. There was like an older gent with this animation and two ladies. And I can't remember if his name was Gerald, and he would be doing all of these sort of skateboarding, DJing, and all these very kind of young, what you would associate as young activities. And it was kind of quite humorous and again quite jolly, and they were portrayed in a way that made them really quite appealing to people and kind of got people quite engaged with them. So it was very clever around the way they marketed them, and as we say, with some of the names there, it comes quite a jolly thing, and it in many respects hides some of the reasons why people might be taking out these loans and some of the difficulties that people got in with those. So what payday loans are about, as we said, it's about borrowing money on a very short-term basis, normally to cover emergencies. Okay, and so if maybe your car breaks down or something happens to something in the home and you need to pay a bill, or your boiler breaks down for your heating and you haven't got the money in savings and you don't have the money left from when you previously got paid, you can take out one of these loans, pay the immediate amount of money that you want, and then you are able to, and then ideally pay that back in a very short amount of time, maybe a week or 2 weeks when you next get paid. And one of the big advantages with these loans is that they're very, very quick to get a decision about whether or not you can borrow from them. So you can go up there. There was always talk about, use the sliders on screen to look at how much you could borrow and how much it's going to cost you. So you could go very quickly onto a website, and they were all done all done online. You could go onto a website, see exactly how much you want to borrow and how much it will cost you to borrow it, and when ideally you should pay it back. So the idea was that you could get money very, very quickly. Literally, a decision could be made about whether you could borrow through them within a few minutes. Once you've applied online, very, very quickly, you get a decision to say, yes, you can have the money. And then literally within a few hours, that money is transferred into your desired bank account to then use for whatever you need to use them for. So very quick decisions, short-term borrowing, and it's very quick to get the money into your bank accounts. So these are some of the advantages of payday loans. They were also, if you remember, we used the term unsecured borrowing and secured borrowing last week in the last session. Payday loans are unsecured, so there isn't, you don't need to put an asset against the loan, so you don't need to put any collateral as the borrower in case you can't repay the loan and you have to sell it to pay the loan back. So there's no requirement for anybody to do that. So again, if an individual had quite a checkered past with borrowing, payday loans were quite a good way of getting money quite urgently. So as we said, very quick decision. But as Tutu said, the interest rates that people had to pay to borrow this money were excessive. And there has been regulation that has come in within the UK to try and regulate some of that more heavily and to kind of bring some of those interest rates down. What sort of interest rates can you remember some of these were charging when they were first around?
They were thousands of percents. You'd see the small writing at the bottom of the TV, and it'd be, you know, APR 2,500%, and you'd think, have I missed a decimal point somewhere? But you hadn't.
No, and last week we were talking about interest rates that maybe you would pay on a personal loan that could be anything between, I don't know, 3% and maybe 8%, something like that. And we spoke about mortgages, where you could take out a mortgage now, and if you, you know, first-time buyers might pay more in interest, but those that already have a mortgage, you're looking at anything between about 1.5% up to maybe about 4%. So comparing those sorts of rates of interest with what you're having to pay for a payday loan, where they were sort of 1,500 to 2,000% interest, you know, it's crazy, crazy amounts of interest that people are expected to pay. Sorry, Monica, were you going to, did I interrupt you there? Were you going to?
Oh, I was just about to say that I think in the US, I read an article this morning that payday loans were around 500%, and that most people don't even notice that when they sign up for the loan, and actually doesn't fall under sort of government scrutiny, whereas most loans do. So therefore, that's why they're able to charge such high interest rates. And so it's really something to pay attention to.
Yeah, thank you. Yeah, absolutely. Totally right there. And again, for those of you that are interested, there is a video that I've posted on the classroom, and actually at the end of this video on YouTube, it will come up at the end as a video that you can actually link to and watch. And that looks at, in the UK, young people that had used these loans to borrow money and had got themselves into a real financial difficulty, hadn't paid them back quickly. And the interest, you know, we're talking about 1,500%, 2,000%. I mean, even recently, as Monica said, in the US, you're looking at loans that you are getting charged about 500% interest, huge amounts of interest. And even if you're borrowing small sums, if you don't pay it back quickly enough, you then pay interest on interest. So you get compound interest taking place, and therefore the amount that you have to pay back keeps growing and growing and growing and snowballing to the point where people then find it very difficult to repay them. Okay, now in the UK, as we said, we saw lots of people having issues with payday lenders and payday borrowing. And so the UK government, through primarily the regulator for one of the regulators for financial services, stepped in and introduced regulations to try and stop some of the issues that were happening for borrowers borrowing through payday loans. So the regulator in the UK is one of the bodies that sits kind of within the regulatory sphere for financial services. Is known as the Financial Conduct Authority, or the FCA, and they do a few things, but they generally focus more on kind of consumer protection within financial services. So they deal a lot around kind of personal financial products and regulating those. So in 2014, they took over regulation of the consumer credit market, and what they did was, based on some of the issues that were occurring around payday loans, they changed some of the regulations that are around them. So One of the things that wasn't happening for people when they were borrowing through this route was that they weren't being checked by lenders whether they can actually afford to borrow. So again, kind of they were quite happy to lend to people that maybe didn't have brilliant record for repaying them, and therefore they weren't able to making a judgment about whether, ethically, again it comes back to ethics and acting with integrity, were they doing the right thing lending to people that perhaps couldn't repay this money, or had a history of not being able to repay loans in the past. So they weren't doing those, and then this regulation came in to make sure that payday lenders were getting involved and making sure that they were checking whether individuals could afford to take these loans out. They were also looking at things like the warnings that were being placed on advertisements and promotions. As Tutu and Monica said, that they literally, it would be in a small print at the bottom, the interest rate. So when the adverts came up on TV, you would hardly see that at the bottom of the screen, it was telling you that the interest rate was about 1,500%. And as Monica said, in the US, even at 500%, people aren't really kind of taking notice of that. It's difficult to know. So people weren't really able to get a clear steer on some of the risks that they were getting into when they were borrowing this way. We also saw, I've noticed probably in the last few years just how payday loans were advertised incessantly on television in the UK. You used to see adverts for them constantly. I very rarely see them now on television. Very rarely see them. So again, it was a bit of a kind of clampdown on how they were advertised, a bit like junk food, not allowed to advertise after a certain time and that kind of thing. They put restrictions on that as well. And what they also did was they changed the price structure to protect borrowers. So they made it so that you could only pay a maximum daily interest of 0.8% a day. And they also capped what we would call default fees at £15 to protect customers. So if you didn't pay the loan back or make a payment on the loan, the fee that they could hit you with as the borrower actually was capped at £15. Okay, so that was to try and protect people that couldn't pay the loan back, because if you didn't pay it, they would add the £15 on top of what you owed and the interest, and then if you still didn't pay it, you would get another default payment added to that, and plus the interest again when you hadn't paid it. So it would build up and you get the compound interest that takes effect. They also capped the maximum cost of a payday loan at 100%. So as a customer, you would never have to pay interest that exceeded the amount of that loan. Okay, so there was a lot brought in by the FCA, the Financial Conduct Authority, that tried to help protect the borrower from some of the pitfalls of payday lending. So again, I'll refer you to that video on the Google Classroom, and that will appear at the end of this video on YouTube, to have a look at that and look at some of the hopefully won't depress you too much, but just kind of gives you some of the warnings and some of the issues that were caused by these. So yeah, again, these can be really useful for people that need to borrow money on a very short-term basis to cover an emergency, but they should not be used as a way to borrow money longer term. It's a bit like an overdraft. You wouldn't borrow via an overdraft over a long period of time, and the same should apply with a payday loan. Ideally, you should pay them back once you get paid, so within about a week or 2 weeks, perhaps, of borrowing that initial money. Okay, excellent. So that's payday loans. Quite a controversial one. Is there anything before we move on? Tutu, Monica, Arnie, anything you want to add there? No? Okay, excellent. Right, good stuff. So that's payday lending. So the second, should we say the fifth one in the six that we've looked at over the last couple of sessions, we are going to just talk about credit cards. It's another way that retail banks and financial services firms can lend to personal individuals or retail customers. Okay, just Tutu, Monica, Arnie, do you all have and use credit cards?
I do. Yeah,
I do as well.
All nods from everybody. can I just ask kind of what you generally kind of use them for? Do you use them for emergency purposes or? Go on, Monica,
credit cards in general. I use them for almost every day for buying things, at grocery store shopping and all of that. But are you talking in terms of loans that you can get, or sort of?
So in terms of just your personal general usage of credit cards. So can I ask, so when you buy things on your credit card, like everyday stuff, so just to clarify, so you're talking about you're not using your debit card, you're using a credit card to buy bits and pieces.
Yes, so, that's right.
Bit of a personal question, and you can tell me to go away. But just kind of asking, why do you use your credit card and not maybe use a debit card?
So I think there are a couple of things that sort of merit using a credit card. One is it doesn't come directly out of your bank account until you have to pay it at the end of the month. And so you're able to sort of manage your purchases for that month. And then obviously when you get paid from your work, it's a good time to manage the cash outflows. And then in terms of personal choice, I also get points on my credit card for British Airways. So not that I'm using British Airways that much these days, but when I can, it's actually a good perk.
Yeah, sure. Yeah, really interesting. I thought you were probably going to, when I asked you the question, that those are sort of some of the things that you probably were some of the reasons why you use your credit card rather than your debit card there. Absolutely. Do you kind of budget yourself, or do you kind of keep on top of how you're using it, how much you're using it? Because the temptation could be, we're talking about literally a plastic card that you use to pay for things, and you're borrowing the money rather than it coming out of your bank account. Are you quite methodical about the way you use it and plan how you use it?
I should. I probably don't as much as I do. I should. But I would say that most credit cards allow for online banking, so you're able to sort of see everything. So if you were diligent about it, you could look at it on a daily basis, on a weekly basis, just to make sure that you're not spending too much.
Yeah, sure. Yeah, no, thank you. Thanks very much. Arnie, how do you use your card? Do you use it in a similar way to Monica?
Yeah, very similar. Again, similar to Monica as well. I think one of the perks is, hopefully getting some points that you can use, either it's for travel or there's other perks sometimes where you can get discounts of specific shops and things like that, the more you frequently use the card. So I'd say, yeah, very similar to how Monica uses it.
Yeah, thank you. And Tutu, what about yourself?
Again, very similar. So I use it for everyday purchases just because it's easier to budget household expenses. So, for example, my partner and I have a credit card that we both use, and then at the end of the month we divvy up expenses. It's easier to do it in one go rather than every day. And yeah, we do pay it off every month. So that would be for me, that would be to not pay it off every month would be a no-no, because some of the interest can be quite prohibitive. But yeah, for me, it's just a handy budgeting. It's just easier to manage than using cash or debit cards every day.
Yeah, sure. Yeah, absolutely. That seems to be, talking to the three of you, that seems to be the theme, and some of the perks that you get with those kind of outweighs some of maybe the drawbacks from using credit cards rather than your debit card. And yeah, it's really interesting. I think for a lot of people, credit cards have become exactly what the three of you have spoken about, kind of the go-to payment method of payment for everyday stuff, and it's really interesting. But ultimately, just for the students, so what we are talking about here, as we said, is like your debit card that you put into a cash machine to withdraw money, and you can pay for goods over the counter with. The credit card is exactly the same thing, but instead of taking money from your bank account, so the money leaves straight away, you were technically borrowing that money from a bank or a financial services provider. Okay, now the interesting thing about this is that with credit cards, it's not like a personal loan where you borrow a set amount of money. So the way credit cards work is when you want one, you apply for one online, or you can fill out paperwork, and you might choose a credit card based on, as Arnie, Monica and Tutu were saying, it might be that you travel a lot and there's a particular type of credit card that offers you air miles or Avios points or whatever that might be, that could come in really useful maybe if you want to take a holiday, or you might get cash back on purchases at certain retailers. So there are some real benefits to using a credit card on a day-to-day basis. So you choose the credit card you want. You might look at the interest rate that they will charge you. And a lot of these credit card companies will give you initial offers. So it might be that they kind of try and draw you in and attract you as a consumer, because what they want is they might turn around and say to you, well, we'll give you 0% on purchases or 0% on balance transfers for a year, 2 years. So there are some initial deals you get with credit card companies or financial services providers that offer credit cards that kind of try and draw you in as a customer. And like I say, some of that might be you won't pay any interest on purchases for a month or 2 months or something like that. So you apply for your credit card. The turnaround to actually get your card and be able to spend is actually fairly quick. Again, it's not as quick as a payday loan, but you might have a decision about your credit card maybe in about a day, 2 days, and then you may even receive your credit card in about 3 or 4 days. So within about a week period, you could have your card set up and receive your card, and you're ready to spend on it. Now, as I was saying, the difference between the credit card and a personal loan is that what you will get assessed based on your credit record, and they will look at how much they think they should give you as a limit on that card. So your credit card will come with a credit limit, and what that means is you cannot spend beyond your credit limit on that credit card. So unlike a personal loan where you basically say, well, I want to borrow £5,000 to buy X, what a credit card company will assess your credit record, and they will then turn around and say, right, well, that card will have a limit of £2,000, £5,000, £10,000, whatever that might be. And you can use that card and buy things on that card up to that spending limit. Okay, so a bit like an overdraft where you can use or buy things and then you can put the money back. That's a bit like how a credit card works. You don't have to pay it all up front, you don't have to pay it all off, but just beware, as Tutu said, if you don't pay it off every month, the full balance of what's on the card, you will get charged interest if you're not on a deal with a credit card company, and that can be quite expensive. So credit cards are an interesting way to borrow money, and quite flexible, as we said. So you can spend money and then pay money back off it. A bit like an overdraft, it's very flexible. You can keep kind of dipping in, paying it back, borrowing more, paying it back. So it's quite a flexible way of borrowing money. One of the things you have to be quite aware of is that credit card companies like to change the interest rates, and they can do it quite frequently. So you might be given an initial rate of interest of say 19%, and normally credit card interest is in double digits when you end up spending money on them. So you might have a credit card with 15% interest, some go right up to 28%, 30%, some even higher than that. Not on the same kind of crazy levels that crazy interest rates that you would get on a payday loan, but they can be quite significant. So just be wary when you're using credit cards, especially if you've got a promotional rate where you're not paying interest for a few months, and then suddenly you come off of that and then you're expected to pay 19, 20% interest on what you've borrowed. Now, what you get is you get a credit card statement every month, which now you would get it probably online rather than a paper-based statement, but people still do get paper-based statements. And it will tell you, give an outline of how you spent your money over the month, any repayments you've made on a credit card, any payments to your balance. And it will tell you how much you owe in total on the card, but also they will tell you how much of a minimum payment you need to make on your credit card that month. So you have more flexibility about how you pay it off. So you can either pay the full balance, which Tutu thoroughly recommended that you do, because then actually the interest won't impact you as much, or if at all, because you paid it before the interest hits. Or the other option is that you can, well, there's two other options. You either pay a minimum balance, which they tell you based on how much you've borrowed, they give you a figure of how much is the minimum amount you need to pay off that month. Or you can pay off more than the minimum amount, but not as much as the full amount on the card. Obviously, the more you pay off, the less interest you are going to incur on the money you've borrowed on the credit card. Okay, so these are some of the things that you need to bear in mind. And you're going to see things like credit cards generally are through Visa, MasterCard, and there will be a company that the card is in the name of. So Monica spoke about you've got a British Airways credit card. You said, Monica, was that right? Yeah. So British Airways card, it's probably a Visa. It's a Visa or a MasterCard. So yeah, so credit cards offer flexibility, but the interest rates can be in double digits if you're not on a promotional offer. And as Tutu said, the risk is if you don't pay off the full balance every month, the interest can be quite high. And again, a lot of people get themselves into trouble with credit cards. It's quite easy. It's quite a slippery slope. I recall a personal experience of mine when I was a teenager. I was about 18, 19. I was working. I was getting paid, about 11,000 a year. Very small amount of money. This was a long time ago. And I went on a holiday with my friends, sort of 2-week beach and clubbing holiday, and I wanted all of the designer clothes to, go out with. So I was buying Armani jeans, Lacoste polo shirt, and I spent about £2,000 on a credit card for a 2-week holiday. Do you know, it took me 10 years to pay that off. Wow. 10 years to get rid of that. And that's because I wasn't earning very much money. I was only paying off the minimum balance every month. And it took 10 years to get rid of it because every month they were adding interest and I was only paying the minimum balance off. So I learned the hard way that there are some pitfalls with credit cards that you need to be aware of. And again, we spoke last week, didn't we, about wants and needs. If you really need something, it's different to wanting it. I didn't have to have all the swishy designer clothes. I didn't need that at all. In fact, all I was doing was dancing around being an idiot. So there was absolutely no need to have the designer clothes. I should have been more Primani than Armani, to be quite honest. So you just have to be very, very careful with the way that you use these cards. Anything that any of our guests would like to add to any of that there?
I've got a story about credit cards. So just about spending beyond your needs. I remember when my daughter was younger and she wanted a fancy phone. So I said, that's fine. I'll get a credit card for you, 0% interest, and you can buy your fancy phone. And she had to pay it out of her pocket money. And after 2 years of paying for this phone on 0% interest, she said, I'm sworn off credit cards. I'll never get one again. And I thought, okay, well, that was a lesson well learned.
Yeah, absolutely. Yeah. I think once you get burnt with them, you kind of, it's really, you kind of think, crikey, I could have been in a lot of trouble there. I know a lot of people, individuals that are self-employed that don't have that regular monthly salary, that use credit cards a lot, and the amount of people I know that end up with £30,000-40,000 on credit cards, and then they lose sleep at night not knowing how they're going to pay it off. It's a really slippery slope that people can get themselves into. So probably students, you're getting that don't need to kind of put the fear of God up you, but that there's you just trying to put the point across that you need to be able to manage these finances well. And the temptation with a credit card is that because you're using plastic to pay for something, you're not parting with cash. So there's that disassociation with, you're not actually giving money over to purchase something, you're giving a piece of a plastic card across. So psychologically, it's almost this temptation to think, well, it's not my money, is it? I'm not giving money away to pay for that. and you're walking away with your nice bags, and it all feels really good. And then afterwards, you think, crikey, I've just spent £500. Did I really need that stuff? I probably didn't. Now I've got to pay it back. How am I going to do that? So yeah, just have to be very careful. Monica, Arnie, anything else that you wanted to?
Nothing further.
Okay, excellent. Thank you very much. Right. Okay, and finally, now actually, before we get to that point, really interestingly, Monica, I don't know if you'd seen this, but we've got a couple of examples here. Your British Airways credit card, probably not the same one, but here's an example, and what we were saying about trying to attract customers and different cards for different needs, and this was an example of a British Airways card, and again, going through what Arnie and Monica were talking about, getting travel points, or in this case, Avios points, as they call them. So if you're using this card, £25,000 bonus Avios welcome offer if you spend £3,000 in your first 3 months of card membership. So they're trying to tempt people into spending money on these cards, or collect 1.5 Avios for virtually every £1 spent. Get 2-for-1 travel with companion voucher when you spend £10,000 each year. Okay, right. So you spend £10,000, you get 2-for-1 travel with a companion. And then if you look at the interest rate, 76%. Okay, an annual fee of £195. So again, you just have to be. I mean, this is a premium plus card, an American Express credit card. In fact, the traditional American Express cards, you had to pay. They're not all credit cards. Some of them are charge cards, but you have to pay the full amount back every month. I don't know if they still exist, actually, the traditional Amex American Express cards where you had to pay the full balance every month. I don't know if any of you come across those at all, the old Amex cards.
I actually used to work for American Express, and this is over 10 years ago, but they do still have the charge. They call those charge cards as opposed to credit cards. And at the time, at least, they did still have that, although I don't have one myself. I normally just use this one.
I remember working for, I think it was one of the professional services firms, and all of the partners had those as expenses, as the cards that they put all of their expenses on. So the company used to have to settle that balance up every month for those expenses. So I know that they're used for that purpose a lot of the time. But it's but I mean this example, this British Airways one, offered via American Express is a credit card rather than a charge card. But just to kind of make students aware that they do exist as well, these charge cards where you have to pay the balance off every month. Okay, and I think there's another example here as well. Again, another American Express, and this is slightly different. It's a cashback credit card. So again, as we were saying before, different kind of deals and offers to tempt people in. This one is where the customer can earn a cashback on purchases when you spend in certain shops or on travel, or you get exclusive events. So again, it's that tempting people to spend money there. And the interest rate on this one's slightly lower, 28.2%, and the fee is £25. So it's different kind of cards to meet the needs of different customers. So they kind of tailor them. They just have to be careful, again, like we were saying, about how you use them. But credit cards can be a really effective way of borrowing money if you use them in the right way. And as Tutu, Monica, and Arnie have said, that's they use them on a regular basis and they manage that. And I think if you've got an effective plan to do that, it's a good way to borrow money. There's one other big advantage, is that actually that when you're borrowing money like this and paying it back, if you manage a credit card well, it's quite good for your credit rating, because you are regularly borrowing money and paying it back. So when people are looking to lend you money, if you're managing your payments on these cards and you're managing your spending effectively, it's quite effective to build up your credit score and make you a more positive prospect for lending to in the future, if you were looking to get a mortgage or take out a loan or something like that. So these are quite good ways of building credit scores, but I wouldn't use that as the main reason to use them and spend money on them. But that there is an advantage of them in that respect.
Matt, could we add that some purchases are protected? So if you don't get what you expected from the vendor, you can claim from your credit card. That's another advantage.
Absolutely, yeah, and that's a really good point, Tutu. Thanks for that. You're absolutely right. There's kind of automatic insurance against your purchases when you use a credit card, which you don't automatically get if you use your debit card. So if there was something fraudulent that took place, and say you've gone online and you bought something from a website and it turns out that the website wasn't legitimate, then you could get your money back for something from the credit card company. I've known a number of people where they have purchased things like petrol or tickets to concerts or sporting events, and they bought them through websites that they didn't know were fraudulent, and then they were able to get their money back very, very quickly via the credit card company. So there's kind of built-in insurance into those credit cards that enable somebody to redress any issues should they be victims of fraud while using those credit cards. Yeah, it's a really good point, TC. Thanks for that. Okay, and finally, the last method of borrowing is something called a pawnbroker loan. And if we look at this image here, it kind of gives you a bit of a clue about what we are talking about and how someone can borrow money. Now, this isn't something, pawnbroker loans are not something that, are not a method of lending that retail banks as such would get involved with. So you wouldn't find pawnbroker lending via Barclays or Lloyds or a high street bank. Pawnbroker loans are carried out by specific specialist shops or outlets that you might find on the high street, but wouldn't be a traditional financial services firm, wouldn't be a high street bank. And what we can see happening here is that someone is handing over jewellery for cash. Now, what we're getting at is a pawnbroker loan is basically a shop or a place where someone can take in valuables or assets, something that's worth money, and they can trade it for a cash amount. So if you need money really, really quickly and you're quite desperate for cash, again, a bit like kind of payday loans, but I would put these at almost someone that's even in a bigger need of getting money. You can take any valuable items in that you think might be worth something, and you will get given, they will value it and they will give you a cash amount based on what you've given them. So this is, again, people that maybe aren't able to borrow through traditional means or loans or payday loans or things like that, or credit cards. This is, you need the money, you need it quickly, and so therefore you give something to get the money back. Now the idea is that then at a later date, you go back in with the money that you'd been lent, and you buy your items back. However, that is probably a rarity in the case of pawnbroker lending, in that it's highly, highly unlikely that an individual goes back in with that cash and buys their items back from the pawnbroker. Okay, so ultimately, this is about lending to individuals, and you take an item of the individual and lend them the money on the basis of what you've given them. Okay, so it's exchanging an asset or a personal item for money. Okay, and as I said, you then need to go in with the cash to buy your items back if you want them back at a later date, but often it doesn't happen. So the item that you take in for cash has to have a monetary value. Now, there's a number of downsides to this. The first is that often the item that you take in for money, it's highly likely that it isn't something you really want to get rid of. Okay, but you really need to get this cash. So not only does it have monetary value, but it also may have sentimental value. So in the example here of jewelry, some of that jewelry may have emotional ties or sentimental ties to you. because it was something that maybe was given to you, passed down to you, something like that. So often there's an emotional tie to this as well. It's not just the monetary value of that item. Okay, so sentimental value can also be a factor. This is an example of a secured loan because you are parting with an asset, which that's the whole basis of lending you that money, because then what the pawnbroker does is if you don't go back in and buy that item back, they will then sell that item. Okay. Now, here's where another big downside, another big catch comes in, is that what's likely to happen, because you go in there and you're fairly desperate for the cash, okay, the pawnbroker doesn't know how reliable you are. They don't make checks on you in terms of how reliable you are as someone that owes money and will they pay it back. So what they do is they pay a much lower amount for the item you take in than it's probably worth, okay, because the pawnbroker wants to, if you don't go back in with that cash, they want to be able to sell it and make a profit on it. So the likelihood is you won't get the true monetary value or financial value of your item when you take it in and you pawn it in the shop. Okay, so not only does it have sentimental value often, but it also, you often don't get a fair price based on the true value of that item. And as we said, that is because it's not really clear how reliable you are and how likely it is that they will get their money back, and they need to make money if they need to sell it. Oh, sorry, gone too far. So the other advantages, so it sounds like there's more downsides than there are upsides to borrowing via a pawnbroker, but the other thing is you get your money very quickly. Okay, so if you're really desperate for cash, you get your money very quickly. So the decision about whether or not to lend to you is made very, very quickly indeed. Okay, so this is you don't see, we were talking earlier, I'm saying you don't see many of these around. You don't see many pawnbroker shops around. There are some shops that kind of operate on a similar basis that might not be pawnbroker lenders as such, but you don't see huge amounts of these around anymore, although they do still exist, but not as prevalent and frequently seen as they may have been probably 10, 15, 20 years ago. So you could say that a pawnbroker loan actually is quite expensive when you think about it, especially if you are not getting a fair value for your items. So it's generally considered that it's more expensive to borrow this way than if you were taking out a loan or an overdraft. And we kind of touched on several reasons for that. And it's the risk that is taken by the pawnbroker. So unlike with a loan, say a personal loan or a credit card, they can't run, the pawnbroker is not going to run credit checks on you. Okay, they can't do that. So they don't know how reliable you might be if you're going to borrow this way. They don't know how reliable the borrower would be in paying the money back. Therefore, they're taking more risk. And if you remember, we spoke about the risk and reward relationship or trade-off a number of sessions ago. The higher the risk, the higher the reward. So the higher the risk taken by the lender, the pawnbroker, probably the more costly it's going to be for the borrower to borrow that money. Now, when we've spoken about secured and unsecured borrowing, we've said previously, and we'll mention in a minute, that secured borrowing tends to be cheaper. Well, in this case of a pawnbroker loan, that doesn't really apply. And that's purely because of the risk that the pawnbroker is taking, because they don't know much about you or the borrower that's borrowing that money. Okay, so it's generally considered to be quite an expensive way of borrowing. Okay, and then that kind of brings us to this really, which is just kind of recapping, and we've mentioned this a number of times over the last couple of sessions, this difference between secured and unsecured borrowing. And as I said, we kind of think back to that risk and reward relationship that we had and we've spoken about a couple of times. So just to recap, that unsecured borrowing is when you have a loan that does not have an asset tied to it. So in other words, you don't need to provide collateral. You don't need to give the assurances to the lender that if you can't pay that loan back, you've got something that you will be able to sell that will then give them the money. So an unsecured loan means that You don't have to provide that asset. Okay. So this means there's less certainty for the lender of the money, and therefore it's more risky. So generally speaking, there would be higher rates of interest. It will cost more to borrow via unsecured loans and services, products and services of that nature. So again, the higher the risk in this example with unsecured, it's higher risk, therefore higher reward for the lender, therefore interest rates are likely to be higher than secured loans or secured borrowing. And then secured borrowing, to recap, is when you have an asset or something tied to the loan that can be sold off if you're unable to make the repayments on it. And the example that we used last week was a mortgage where if the house, if you're unable to make your mortgage repayments, and don't get us wrong, it won't happen straight away. It will take a while if you haven't paid your mortgage for some time. They can't just take your house away, on one occasion that you haven't been able to pay your mortgage. But if over a period of time you've not been able to repay the mortgage, the bank, the lender can repossess the property and sell it to repay the money that was owed on the mortgage. Now, because a loan is secured, it means there's less risk taken by the lender. And because there's less risk, there's less reward. So therefore, lower interest rates are probably going to be charged on secured borrowing. The exception to the rule with that, we spoke about pawnbroker loans. Pawnbroker loans are technically secured, a secured method of borrowing, but because the lender doesn't know much about the person borrowing money, it will become a more expensive way of borrowing money to accommodate or to mitigate, to reduce that risk. Okay, so again, just to repeat, the lower the risk, the lower the reward. So if something is secured, interest rates are less than if it was unsecured. And again, the higher the risk, the higher the reward. If a loan is unsecured, it's higher risk, and therefore interest rates charged to the borrower will be higher. Okay, was there any, that kind of sums up secured versus unsecured borrowing? Anything that Tutu, Monica, Arnie, you'd like to add to that at all?
Nothing from me.
Likewise.
No, nothing from me either.
Okay, excellent. Right, so that pretty much brings us to the end of the whole area of retail borrowing that we had to look into over the last two sessions. Now, just a couple of remaining tasks to do for the next session. Have a look at the multiple choice test on retail borrowing in the Google Classroom. So have a go at that if you can there. It's 5 questions just to make sure that you've understood everything that you've looked at and that we've spoken about. And also have a look at pages 30 to 31 of the PDF workbook again, that's in the Google Classroom, that covers off the retail borrowing areas that we've spoken about today: payday loans, pawnbroker loans, and credit cards. So just have a look at those for the next session. So I just want to finally say a massive thank you to Tutu, Monica, and Arnie. Thank you very much for your contributions in this session. Really appreciate it. And I think we will see you again for the session, the next session coming up, where we'll be looking at interest rates, and we're going to be doing some calculations. So for the next session, students, make sure that you bring a calculator with you. Make sure you've got a calculator to hand when you are when you're watching this video or the next video back, because we'll be going through some calculations that you will need to work out. So that's going to test us all next week. We'll get our GCSE maths hats on. So thank you so much again. Look forward to seeing you next week, and we will catch up with you soon. Take care.